Be honest for a second. Have you ever checked your bank account right after payday and thought, wait, where did all my money go? You are working hard. You are doing what you are supposed to do. And somehow, every single month, it still feels like you are running just to stay in the same place. Then you scroll your phone and see headlines like this teenager turned $5,000 into $1 million, or the average investor misses most of the market gains. And you think, okay, clearly I missed something. Because this does not make sense. You might believe stocks are gambling. Or only for rich people. Or too risky. Or something you will learn later when you make more money. Here is the thing though. If you do not understand stocks, you are almost guaranteed to stay broke. Not because stocks are magic. But because stocks are how money actually grows in the real world. And today, I am going to explain stocks for people who do not want to sound smart. They want to be rich. Introduction. My name is Luke, and I spend way too much time thinking about how money actually grows over time. And if you are someone who works hard, saves a little, but still feels like wealth is always just out of reach, make sure to hit that subscribe button and give this video a thumbs up if this helps you. Because this video is not about hype. It is about how rich people quietly use stocks, while everyone else argues about whether they are safe. Part 1. The lie you were taught about stocks. Let us clear something up right away. Most people think stocks are risky. That is not actually true. Not understanding stocks is risky. Here is what most people do not realize. Over the last 100 years, the stock market has returned about 10% per year on average. After inflation, that is roughly 7%. Now you might say, yeah, but there are crashes. Yes, there are. And yet, after world wars, depressions, financial crises, and pandemics, the market still went up. Cash did not. Cash quietly loses value every single year. If inflation is 3% and your money earns 0, you lose half your purchasing power in about 24 years. That is not fear. That is math. Part 2. What a stock actually is. Let us remove the confusion. A stock is not a chart. It is not a ticker symbol. It is not a gamble. A stock is ownership. When you buy a stock, you own a small piece of a real business. That business sells products, pays employees, generates profit. And when businesses grow, owners get richer. Employees trade time for money. Owners trade money for growth. That difference changes everything. Part 3. Why saving alone will never make you rich. Saving feels responsible. Saving feels safe. But saving alone is a losing strategy. Let us use real numbers. If you save $500 per month for 30 years, that is $180,000 out of your pocket. If you keep it in cash, you end with about $180,000. If you invest that same $500 at 7%, you end with over $600,000. At 10%, you end with over $1 million. Same effort. Same discipline. Completely different result. This is the moment most people get uncomfortable. Because it means the problem was never effort. It was strategy. Part 4. Compounding. The boring superpower. Compounding is boring at first. Year 1, nothing happens. Year 5, still boring. Year 10, okay, interesting. Year 20, now the money is working harder than you are. Here is what most people do not realize. Most of your wealth shows up at the end. If you invest for 40 years, more than 90% of your gains happen in the last 15 years. That is why starting early matters more than investing more. And why quitting early destroys everything. Part 5. The psychology that destroys investors. People do not fail because they are dumb. They fail because they are human. Humans buy when things feel safe. And sell when things feel scary. That is backwards. Studies show the average investor underperforms the market by several percent every year. Not because the market is bad. But because emotions are expensive. Fear feels logical. Greed feels justified. Both are lying to you. Part 6. What if I lose money? Now you might be thinking, what if I lose money? You will. Temporarily. Volatility is the price of admission. Gamblers need to be right now. Investors need to be right eventually. Time turns fear into profit. Part 7. Why rich people love boring stocks. Here is something no one tells you. Rich people do not chase exciting stocks. They chase predictable businesses. Companies that sell boring things. Make steady profits. And raise prices with inflation. This is where it gets really interesting. The flashiest stocks get attention. The boring ones build wealth. Part 8. Index funds. The quiet cheat code. An index fund owns everything. Instead of guessing winners, you buy the entire market. Over 90% of professional investors fail to beat the market long term. Index investors win by doing almost nothing. Low fees. Low stress. High probability of success. Part 9. What to actually do? Start now. Even $50 matters. Automate your investing. Remove emotion from the process. Think in decades, not months. Ignore the news. It exists to scare you out of good decisions. Part 10. The final shift. Stocks are not about money. They are about control. Control over your time, your stress, your future. Every share you buy is a vote for the life you want later. The people who get rich from stocks were not smarter. They just started before they felt ready. Closing. No one is coming to save you financially. But the system already exists. Stocks are not a secret. They are just misunderstood. Wealth is built quietly, consistently, over time. If this helped you, subscribe. Because once you understand how money works, you stop chasing it, and you start building it.